Now, this is a fact. According to data published by multiple brokers, over 85% of traders lose money within their first 90 days of trading, even when they're using good strategies or premium signals. The wrong thing they do is that most of them blame the strategy, but what they don't realize is strategy isn't the problem. It is poor risk management. Most traders think they understand risk management, but they don't, and I've seen it over and over again. Someone start with $1,000, flip it to say $1,500, then lose everything in one single trade. In this video, I will show you how to protect your Forex and crypto trading accounts using a free tool I personally use. I also share the same weekly growth system I and my students use, so you can stop blowing your accounts and start growing them. And after watching this video, you might not even need to change your strategy, because even if you only win 40% of the time, you can still be profitable if your risk is right. So here's what you need to know. Before you enter any trade, the first question you should ask yourself is, how much am I willing to lose if this trade goes against me? That is called risk amount. Trading is a game of probability. You will have losing trades, sometimes even more losses than wins, but the goal is to remain profitable despite that. Now, most pro traders risk between 1 to 5% of their account per trade, but as a beginner, you shouldn't risk more than 1%, especially if you are still trying to grow a small account. Now, this sounds simple, but a lot of traders don't even know how to actually do this. I once asked a trader how much he was risking, and he said only 2%. But when we checked his calculation, he was actually risking 55% per trade without even realizing it. Why? Because he just thinks that the amount you enter a trade with is a risk. This is because he doesn't understand what we call position sizing. The lack of this understanding is very common, especially with crypto traders. Now, if you get position sizing right, you can trade with 100x leverage and still only risk 2%. If you get it wrong, you can blow your account with just 5x leverage. This is why I am never afraid of high leverage. As a matter of fact, I personally use the highest leverage available on most brokers or exchanges. Not because I want to gamble, but because it allows me to take larger trades without exceeding my predefined risk. And crypto traders are shocked when I say this, because they've been told to avoid anything above 10x leverage. But when they learn how position sizing really works and run the numbers, they realize they've been doing this wrong the entire time. Now, here is how it works. In crypto, your position size is the total amount you enter a single trade with respect to your stop loss. In Forex, it is expressed as your lot size, and you don't have to do the maths manually. There's a free calculator that does this for you. Just plug your account balance, stop loss, and risk, and it will calculate this for you. Now, before we get into that, you need to understand one more thing: risk reward ratio. This is what truly determines your profitability, even with a low win rate. Let's say your account size is $1,000 and you are risking 2%. That means your risk per trade is $20. If your trade setup gives you a risk reward of 2R, you are aiming to make $40 on every $20 risk. Now watch this. If you take 10 trades and win 5 of them, it means that your 5 wins is 5 times 40, which is 200, and your losses is 5 times 20, which is 100, and net profit is $100. If you take 20 trades that month and maintain the same win rates, your profit becomes $200, a clean 20% return. And that is impressive. Now, you might be thinking, that is more. I want to increase my risk and double my account. No, you don't. As a matter of fact, it is your village people talking. Now, you don't need to risk more. 20% a month is amazing. As a matter of fact, 10% a month is impressive. What you need to do to make more is compound correctly. And I'll show you how to do that in a bit. Because even if your win rate drops to 40%, you can still come out profitable. Using the same example, 4 wins is 4 times 40, which is 160, and 6 losses is 6 times 20, which is 120. A net profit of $40. That is still a win. And with compounding, it gets even better. The key is to always aim for a high risk reward setup. Ideally, 1:2 or even better. This might mean taking fewer trades, but overall, you'll be more profitable in the long run. Now, let's talk about how to calculate risk reward ratio and your position sizing using real trades. We're going to use the long and short position tool on TradingView, and I'll walk you through this for both Forex and crypto. Let's say I want to take this trade from here to, and I use the risk reward ratio, which is this tool here for short position, since I want to go short, and I'm placing my entry around here and taking my stop loss around here and targeting a risk reward ratio of, let's say, 2.73R. This is what my target is. So I'm going to open my position size calculator. Now, supposing I'm trading with an account balance of $1,000, that's what I'm starting with, and I'm risking 2% in this trade. It means that my risk amount is $20, and my entry from this trade is 1.1750, and my stop loss is 1.17965. So I'm going to click on calculate. This calculation tells me that my standard lot size is 0.09. This is what I will enter the trade with. Now, the beautiful thing with this is this: if the trade goes against me, that is, hit my stop loss, I cannot lose more than $20. And if this trade goes my way, I'm going to make 20 times 2.73, which is $54.6 on this single trade. Now, let's look at the crypto example. We're going to look at BTC USD and do the same thing. Okay, let's say we want to take a short position on this particular trade on BTC. So I'm going to get my tool. I'm taking a short position, put my stop loss here, and go as low as this. So this is giving me a risk reward of 2.31. I'm going to go straight back to my FS calculator. But in this case, since I'm placing this trade on a crypto exchange like Bybit or Bluefin, I'm going to click on the Bitcoin logo here for calculation for crypto position size. If I'm risking $1,000 on this trade, so what I'm going to enter here is 1,000, and let's say I want to risk 2%, which is $20 on this trade. Then I'll go ahead and enter and input my entry price, 109,444.34, and my stop loss is 109,815.73. Note, guys, if this was a trade I'm going to take now, I'll wait for confirmations for a different setup before I take this trade. This is not the setup I'm taking. I just want to use this for this example. Now, so from here, you can see my position size is 5894. This is what I'm going to use in entering this trade. To enter this trade, I'm just going to go to Bybit, and this is how it's done. On Bybit, I'm going to come to and select cross margin and make sure I'm going to choose the highest level, which is 100x. Then where we have, if I want to use market order, I can use that. Now, okay, I can it's some limit order. I'm going to enter my entry, which is 109,444.34.3. Now, this is important. Where we have order value, if you click on the USDT, make sure that what is selected is order by value. Again, make sure it is order by value. Confirm. Now go ahead and enter 5 10894, and I can click here to input my stop loss, which is 109,815. You can see that what I'm going to lose if this trade goes against me is 19.647. This is approximately $20, and my take profit if I impute it, 108,585. You can see what I will make is 45.54, which is my risk $20 times 2.31, which is my risk reward. So go ahead and click on open and confirm. So this is simply how to place this trade on Bybit. Now, the second thing is that, I said that you should make sure what is selected is order by value. Let's say you want to use order by cost, or let's say you are using Bluefin, and on Bluefin there's no order by value. What they have is order by cost. So on Bluefin, you can see if I click on this, you will see is order by amount and order by cost. So what you want to choose is order by cost on Bluefin if you're using Bluefin. And I'm still going to select the highest leverage, which is 150x, and it's on cross margin. Then I'll come back to my position size calculator, and where I have leverage, I want to put 150. So this tells me that what I will enter this trade with is 39.3. Don't worry about the minus. So I will then come here under this cost, I will enter 39.3. This doesn't mean I'm risking 39.3. It simply means I'm only risking $20 as I enter my stop loss and my take profit. So limit price, so that is how to use this calculator to enter a trade on using either order by cost, which is offered by a lot of exchanges, or using my order by value, which is also offered on a lot of exchanges. And you're able to risk the exact amount you want to risk. If you understand this system, you can never blow your account. Now the next step is how to compound your results to maximize your growth. Let's talk about that. So compounding can be done daily, weekly, monthly, depending on what works for you. However, daily compounding is less likely to be profitable for beginners compared to weekly or monthly compounding. As a matter of fact, don't do daily compounding. As a beginner, you should start with monthly compounding. Even as a pro, you can start with monthly compounding. Then you can now move on to bi-weekly or weekly compounding as you get better and you are more consistent. Now, here is how monthly compounding works. At the end of each month, you add your net profit to your balance. Then you calculate your new risk amount based on your updated account size. That is it. It's that simple. I prepared a spreadsheet for this, and I will link it to the description of this video. Now, let's say your account size is $1,000, as you can see here, and your risk reward is 2R. You're risking 2% of your account, and you take 20 trades per month. Win rate is 50%. Now, see what happened. At the end of January, let's say at the end of January, your account balance is going to be 1,200 because you made 20% a month. For February, your new account balance will be the end account balance, which is 200 plus the starting account balance, which is now 1,200. Your ending account balance for February is $1,140. Now, over a period of 1 year, because this is from January to December, you can see that maintaining the same thing, your account balance is now 8,916. If you continue for the next year, at the end of the next year, it becomes 79,497, and the third year is crazy. It's now $708,802, just from $1,000 within 3 years. So this is one scenario. Now, it gets interesting because you can actually tweak this value. Let's say your account size is $2,000, for example. You can see this at the third year, you're having 1.47 million. And let's say we maintain this, and you are now, your risk reward has improved. It's now 3. If you use 3 here, you see, and the second year is 3.2 million. And so you can tweak a lot of these things. You can tweak different values to see where it is. If you're risking more, which is not advised, you can see the amount you earn also increases. And if you're taking more trades, or let's say your win rate increase to 60%, you can see what happens. This is of course ideal, right? You can actually change any of these things to see what the value comes to. And I also prepared a weekly compounding as well. If you want to do weekly compounding, you can change the value. For example, if you compare the weekly and monthly compounding, for the weekly compounding for the first year is 11,918, second year is 142,000, and third year goes astronomically to over 1 million. Now, I'll drop the link to this sheet in the description so you can play around with it and see the possibilities that are there. Now, all of this looks simple on paper. The truth is that it is not easy. It takes habits most people avoid, which is discipline, patience, practice, and experience. The truth is that even with all these habits, say you have all these habits, you might never achieve these results. Of course, you need to withdraw the other things that are there, but what it's sure is that you will not blow your accounts, and you will become profitable if you just maintain these habits. Another habit that separates those who talk about trading from those who actually win is called journaling. I know you've heard this. Journaling helps you to show up consistently, stay committed, identify your mistakes, track your progress, stay disciplined, and finally start winning. There are 2 sides of journaling. The first one is to track your trades. So here, if I click on crypto journal, you can see you can enter different things here. Let's say you're setting $1,000. So every day when you take a trade and you're risking weekly compounding and you're risking say 3%, but don't go to 3%, start from 1%. So you're risking 1%. And so every trade you take, for crypto, for example, you can know the position size. Enter the position size here. The way I did it is that you can actually know the fee the exchange charges you. The fee is also calculated here. You only enter values into the position size section, actual profit, and the asset your trader knows. So here is where you enter the position size of each trade and the actual profit you make per trade. You enter it here. Let's say my target is $60, but I made $50. I'm going to enter it here. So this calculates my end balance for me for that particular trade, and the actual profit is 5% of my account balance, and that is it. So say the next trade, I'm still targeting $60. Let's say this time around I make 70. It calculates my end balance. It just calculates everything for me, and by the following week you can now change your starting balance and continue compounding. The same thing is for forex as well. So here I have lot size since we're doing forex, and you just do it the same way you do it for crypto, the same shit. The second part is even more powerful. This is screenshots. This helps you to increase your win rates, trade better, risk to reward setup, and avoid unnecessary losses. So it's simply, you take a screenshot of every trade, the entry, setup, exits, review them daily and weekly, and ask yourself, why did I take this trade? Why did this trade win? Why did this trade lose? Did I follow my plan and all that? These 2 things I've mentioned, that is the journaling and the screenshot, they sound boring and like a waste of time. You think it doesn't add anything to your trading, but doing this can take your win rate from 15%, which is where most beginners start from, to 40%, then 50% or more, just by learning from yourself. You have to do this to learn from yourself. And again, it separates losers from long-term profitable traders. Now, you know how to protect your accounts, manage risk, and grow it with compounding. The next step is simple. how do you actually find the right trade to apply this to? Because let's be real, even the best risk management will not save you from a bad trade. The first thing you can do is to join my community for access to trade setup, signals, and supports. The steps to join I'll leave in the description of this video. Secondly, you'll have to stay subscribed, because in the next video I will show you the exact method I use to spot high probability trade setup, from reading structure, using entry confirmation, and timing the market.